Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
On today's episode of Swimming with Allocators, we're blessed to have Mr. David Clark. And if you have been following venture capital on X or LinkedIn, you've probably seen posts from David. He's CIO of VenCap International. And we're really excited to share this conversation. And Alexa and I were both excited to ask him about how to use data to really determine which types of firms to invest in. Also asking him why the power law is intensifying and not going away. And lastly, his thoughts on secondaries and if you should have a desire to get a discount on it. So with that, we welcome you to hear our conversation with David Clark. On today's episode, we have David Clark. He's a CIO at VenCap, one of the long-standing and most respected fund of funds in our global venture capital ecosystem. With 30 plus years of analyzing venture cycles, technology shifts, and manager durability. He's well known for really breaking things down from the data and not just vibes. Today, we're going to chat about why venture is returning to a power law world. Asking the question, is there a middle class in venture? Can there be one? And then a whole host of other things. So with that, we welcome David.
Great, Ernest. Pleasure to be here, Alexa. Great to see you for the first time as well. Looking forward to the conversation.
Thanks so much.
As am I. I wanted to start out, a lot of people from, our audience of allocators and venture capitalists might know you from your very informative tweet threads that are very data driven. I wanted to ask kind of like what experiences, kind of getting some insight of how you got to this world, kind of led you to always kind of looking at things from a data perspective. Was there a certain role or, I don't know, childhood experience?
Nothing that really jumps out. I think part of the reason we do it at VenCap is, we started off as venture investors with an approach that was fairly similar to what a lot of LPs are, which is, you meet with a load of managers and you try and figure out which ones actually are going to be successful and which ones aren't. And we found that we were not really much better than the market. I mean, slightly better, but not materially better. And so we just thought there's got to be a better way of doing this. And that's where we really then sort of turned to the data side of things. And tried to sort of understand a little bit about, what is it that actually drives venture returns? What does the market look like? Not from anecdotal perspective, but from, a real underlying data perspective. And I think it just kind of snowballed from there.
I was just curious, making that shift, were there underlying assumptions you had that the data corrected you on? And I understand you've been in this seat for 33 some years, so this is probably ancient history. But when you did start sort of looking at things more quantitatively?
Yeah, I think again, like a lot of LPs, we were surprised at what the average performance of LP funds ultimately looks like. And I think there was definitely a sense that we could kind of buck that trend through having a rigorous diligence process and spending a lot of time with the managers, understanding their strategy, understanding their process. And really we found that those were not accurate predictors of how a fund was ultimately going to perform. So yeah, I think that's really what was driving it from our perspective.
There's a lot of data in public markets, not as much in the private market. So how do you, like when you're even, let's say, there's a new fund of fund or a new allocator looking to go into venture, how do you even aggregate the right data? and match that to a lot of things that are being said in pitches and that are more anecdotal? How do you, make things apples to apples instead of apples to xylophones? I don't know.
I think it's really hard for new entrants because, as you said, a lot of the publicly available data isn't great. Even something like PitchBook only has returns data on a very small percentage of the funds that have actually raised capital over a particular period, and they're missing chunks of the market as well. So I think it's very difficult to draw really strong conclusions from the publicly available returns data. And the other feature of venture is that the feedback loop is just so long. At least when you were an equity analyst, you could kind of every quarter you had a scorecard that you could kind of go back to.
Exactly.
Whereas in venture, it takes 10 plus years before you kind of get any sense as to whether the assumptions that you had in place when you made an investment actually are going to prove to be true. And one of the things actually we found is in some instances, we invested in funds that were very successful, but they were very successful for reasons that were completely different for the reasons that we actually made the investment in the first place. So it just feels that within venture, there are so many unknown unknowns when you go into a fund that I think it just takes time for any allocator to experience those, to kind of look back and figure out why has something worked, why hasn't something worked, and then hopefully draw their own conclusions from that experience.
Can you give us any examples of what you thought? What was the convincing data point, but then what actually ended up making the difference?
I think one of the things that was really interesting, I look back and there were a couple of managers we backed where I did the diligence early in my career and spent a lot of time meeting with the manager, going through their process, understanding the team, understanding, what they were looking for, and really feeling I knew their firm inside out. And what I realize is sometimes the more time you spend looking at something, the more you end up with confirmation bias. And so one of the things, we try and do now is do a lot of our work on a firm before we meet them for the first time, so that we actually have a view as to, is this something that kind of fits our bar? Is it something that has the characteristics that we look for? And I remember reading something that Warren Buffett wrote a while ago, where he said that most of his work is reading the quarterly reports and the annual reports of companies. It's not meeting with the CEOs and the executives of those companies, because they bring a narrative that is actually quite a distraction. And I think that's true in venture as well. I've said before that I still come out of just about every meeting with a VC wanting to invest, because the narrative is just so powerful, and these are super impressive people. And it's only when you kind of take that step backwards and kind of really appreciate the context and how hard venture is, and the fact that most funds don't produce returns that are worth it from a risk return perspective. And similarly, most venture-backed companies end up losing money for their investors. It's only when you have that perspective that I think you then start to ground what you're seeing and what you're hearing in some sort of reality.
What you're describing makes me think this actually could be a healthier, could bring healthier outcomes.
It's
getting in the weeds a little bit.
Yeah, I think that the role of a GP is very different to the role of an LP. And if I had to put, how much of it is, how much of the success of a company is kind of based on the quality of that sort of founding team and the entrepreneurs, it feels like that, that's relatively high. And so I think, if you're able to develop that filter where you can recognize what a world-class founder looks like, I think there's no substitution for that. And, one of the things we've seen when we're talking to the GPs we back is that the fact that they have been working closely with, multiple highly successful founders gives them a pattern recognition that I think is over time is really helpful. And that's not to say you can't get someone coming from left field that, looks and sounds very different to, the bulk of founders who can't be successful. But I think they're able to kind of cut through quite quickly to understand, does this person have the characteristics that we've seen from our successful founders previously? And I think that's one of the things that really differentiates the very best managers is they've seen what world class looks like from the inside, and having that past experience, I think, is incredibly important.
David, real quick for our other allocators, what are some kind of tips and tricks on this kind of like doing the homework before you meet these founders that has worked really well for you all?
Well, I think for us, it comes back to understanding what really drives returns within the venture industry. And what we've found is that, we've talked a lot about venture being a power law asset class and how a relatively small percent of companies ultimately drive the bulk of returns for the entire industry. So I think, our main filter really is, how many times has this particular manager been able to back one of those top 1% companies? And then the second level down is, and have they been able to really move the needle from that single investment? So for an early stage fund, we want a single investment to return the entire fund and hopefully multiples of the entire fund. For a growth fund, we still see the best companies being able to return 100% of the growth funds. But I think more realistically, we're looking for a single company to maybe return a third to half the fund. And so it's those two kind of filters that we would really look at first. And that ends up, coming out with a relatively small number of names within the industry that kind of that pass those two filters.
How then do you gauge repeatability versus, well, that they happen to invest in their college roommate?
Yeah, I think it's, that's the challenge. What we'd like to see is multiple partners at a particular firm being able to do that on more than one occasion. We've struggled backing solo GPs, because I think it's, the sort of risks that we're willing to take within venture are probably, I think they're misaligned with a solo GP. Again, not to say that there are some unbelievably successful solo GPs out there. And, in hindsight, we would have loved to have been investors in those. But I think we feel that where we're wanting to, the sort of risk that we're willing to take is, can this manager back a top 1% company? And can they return the fund from doing it? I think what we don't want to take is kind of the same level of risk around firm, around operations, around, is this single partner going to stay in venture for the next 20 years? Because, realistically, it can take that long for a seed stage fund to go from first investment to fully liquidated.
One of those that has come up is this idea of even like power law. I know as we've had more entrants in the market, some people are like, no, I don't have to have, maybe I can get a lot of 2Xs or a lot of, a lot of triples and doubles and have an outperforming fund. You all came out with a paper that said power law is not getting smaller, but it's intensifying. And so I just wanted to give you the opportunity, like, can you share kind of some of the findings and why you all feel that way?
Yeah, I mean, again, we go back to the first principle. When we look at funds that have returned 3x net back to us, 92% of early stage funds have at least one company that returns the entire fund. And I've seen a number of our peers come out with similar statistics as well. So I think it's very clear that the power law does exist in venture. And we've yet to see that model where singles and doubles can generate strong outcomes at the fund level. Again, not to say that it's impossible, but if I'm willing to take a bet, I'd be wanting to maximize the probabilities of being successful. And for me at the minute, that means, adopting that power law framework as we're looking at managers. And then really the paper we put out was kind of suggesting that, the power law was going to intensify. And this was really something we did on the back of having had, 4 or 5 years, between 2018 and let's call it 2022, where the market was going up, where everybody was able to show strong performance, where companies were able to raise capital relatively easily and at higher valuations. And it felt as if that was a part of the cycle that was coming to an end. And for perhaps 18 months, that was the case. And then we had the AI wave, which kind of jumped back in.
Yeah.
And it feels like we've kind of gone back to that a little bit over the last kind of 12 to 24 months. But I think at the time we wrote the paper, we just felt that we were going to see fewer companies being able to have the underlying metrics that then justified investors giving them additional rounds of capital at higher valuations. Yeah. And when we saw what was happening, particularly at on the IPO market, it was clear that you need to get to a certain scale in order to get the attention of the IPO market. And there were going to be fewer companies that were probably going to be able to reach that scale. And I think if you look over the last 12 months or so, it's interesting when you look at the exits that have happened. There've been a relatively small number of IPOs
Yes.
and M&As, but the valuations have been pretty high. I look at stuff that we've had out of our portfolio, and there's probably been 3 or 4 companies that have been able to exit at kind of north of $20 billion over just the last 12 months. And I think that's indicative of that kind of power law intensifying. The flip side of the power law is more companies will fail as well, which I think is important to understand. And we definitely felt that kind of post the correction we saw in 22, 23.
Yeah.
We were going to see a lot of companies that had been able to raise money at high values ultimately fall away. And we saw that to some extent. It still feels like there's a bit of that story still to play out, because those companies have done a great job at preserving capital and extending runway.
Now we're going to take a quick break to speak with our sponsor.
What do you make of the Acqui-Hire team grabs? You were in the news, you're reading about Meta and Scale AI and Google and Windsurf. What should our VC audience make of that trend?
The AI Acqui-Hire wave we are seeing right now is genuinely unprecedented in both pace and scale. What Meta's doing with Scale AI's talent, what Google's doing with Windsurf, these are not traditional acquisitions in any meaningful sense. These are talent raids dressed up in deal clothing. The acquiring companies are not buying products or revenue streams. They're buying people. And specifically, they're buying the small number of people on Earth who know how to build and deploy these frontier AI systems, right? So for VCs, there's a few critical takeaways. First, I would say this trend validates the thesis that human capital is the single most valuable asset in AI stage companies. That means that the diligence you do on founding teams, key technical contributors, and the agreements that bind them to the company are more important than ever. Second, I would say VCs should be thinking hard about whether their portfolio companies are structurally resilient to these kinds of talent extractions. If a big tech company can walk in and effectively disassemble your investment by hiring away 6 engineers, you have a portfolio risk problem, not just an HR problem. And then the last thing I would say is that the deal structures themselves are worth studying. The Acqui-Hires often involve licensing agreements, infrastructure commitments, and other creative mechanisms that allow the acquirer to avoid a traditional M&A process, which means that the standard change of control protections in your term sheets may not be triggered.
Oh, wow.
So you should be auditing those provisions now before you're on the receiving end of one of those transactions.
Oh, man, I hadn't thought of that. Can you give an example of how Acqui-Hires can be structured to avoid triggering some of these change of control provisions or some of these other nightmare situations?
Yeah, so the key point is that many of these deals that are structured as talent acquisitions paired with technology licensing agreements are deliberately structured as something other than an asset or a stock purchase, right? So the acquiring company is hiring away the key team, licensing the target's technology or IP, and in some cases, they provide cloud computing credits or infrastructure commitments as consideration. But because no entity is actually acquired, because no stock changes hands and no assets are purchased in a traditional sense, the change of control definitions in most venture financing documents are never triggered. Mm-hmm. And what that means is preferred stockholders may not get their liquidation preferences, drag-along rights may not activate, protective provisions around M&A that you've carefully drafted into those agreements may not apply. So The practical advice is to work with counsel to broaden the definition of change in control in the term sheets and in your investor rights agreements to capture these sorts of quasi-acquisition structures, including, I would say, provisions that address the departure of a critical mass of key personnel in connection with a licensing or services arrangement, like one of these things.
Yes, it's rather sneaky because in some cases they're claiming, yes, these teammates are coming over in order to make sure the contract is fully implemented. It's right. This is technically difficult to do, so we need people on both sides to make sure it's effective and the licensing agreement works out.
Absolutely.
But who should be paying your salary in that case? It's interesting.
Exactly.
Is there anything VCs can do structurally at the company level to slow down mass departures?
Yeah, there are a few tools that can be leveraged in a helpful way. I would say garden leave provisions, which is when a departing employee remains on payroll for a specified period of time before they start their new employment. That can create a buffer, although their enforceability varies by jurisdiction, and they are far more common for senior execs than for what you would consider a rank and file engineer. Forfeiture for competition provisions have really been on the uptick lately, and these are provisions where unvested or even sometimes recently vested equity is forfeited if an employee joins a competitor. Those are gaining traction as an alternative to non-competes and as a sort of a retention mechanism. I will say, though, that California courts have not blessed these, and they remain a developing area. There actually was legislation effective January 1st of this year, 2026, in California relating to forfeiture and clawback type provisions. So, you have to be careful with those. But at the operational level, one thing that can be very effective, and it's just kind of creative thinking, is staggering vesting cliffs across a team so that not everyone's equity vests on the same schedule. That can make it really a lot harder for a competitor to recruit an entire team at once because they would have to have staggered ending dates. You can also include robust notice provisions and employment agreements requiring 30 to 90 days notice before a departure to give the company time to respond if it is notified of a departure. But I would say, footnote to that, employees are not required to give you notice, even if you put it in an agreement. So you can use that, but not rely on it.
Interesting. Is this going to be a one flash in the pan kind of phenomenon? Are we going to look back and say, remember all those crazy team crabs? Or is this a new normal?
I think it's a new normal, and it's not so different from what happened many years ago with the dot-com boom, right? That it was a very similar thing that was happening then. It's just changing form now because we're a little bit further advanced in terms of technology and agreements, and we've seen it before, so we're trying to plan around it this time. But I feel like the idea that a big company will want to hire the Einstein of your startup organization is not new. And if they can get away with it, I think they will continue to do so.
Yeah, it's hugely detrimental as the VC when you're losing your Einsteins. So our audience tends to be VCs managing portfolios. They would be working with Sidley's fund management and founder teams. How do you coordinate sitting in your seat at Sidley with those clients?
So I am in labor and employment, and we also have an executive compensation and benefits practice, and we work very hand in glove together. These groups are some of the largest and most sophisticated in the country. We sit right at the intersection of employment law, corporate transactions, and regulatory compliance, which means we're not siloed into one narrow lane. On any given day, I could be negotiating a founder employment agreement for a Series A company, advising a growth stage board on exec comp design, or handling a sensitive separation for a portfolio company that needs to move quickly and cleanly. I think what makes our team distinctive is that we understand the venture ecosystem. We know that a founder employment agreement is not just an HR document. It is a governance instrument that affects board dynamics, investor rights, and ultimately the trajectory of the company, right? So we have deep experience working with venture-backed companies at every stage, and we work closely with Sidley's M&A team, which is a market-leading team, fund formation and tax teams, to make sure that our advice is fully integrated within the broader picture. So we're not just employment lawyers who happen to work with startups, right? We are embedded in this ecosystem and we think like business advisors.
What a cool resource to have. Thank you. And now back to our LP interview. You've been posting about how private markets are the new high growth public markets. So how do you sort of square those two things, that we can't ignore the venture landscape at the risk of missing the most important parts of the growth curve? But it's really hard. Statistically, most people lose at this sport.
Yeah. I do feel nervous about the 401k investors kind of coming into the market without really understanding the dynamics of what the dispersion of returns within the VC industry looks like. And I think there is a risk that a lot of those investors will ultimately end up, being pretty disappointed in the returns that they're able to generate. At the same time, if you do, and this is I think going back to what you were saying there, Alexa, at the same time, if you're able to do venture well, and if you're able to access that small group of companies that does generate, the bulk of the performance, and there's a small group of managers that are consistently able to back those companies, if you can get access to that, then venture is definitely capable of generating, very strong performance and being additive to your portfolio. But I think the reality is that there's only a relatively small group of investors historically that have been able to capture that excess return. And it certainly hasn't been retail that's been able to do it. So it does make me nervous about this. We see something similar in the UK, where the government is very keen for pension funds to put more capital into private markets and into VC, and particularly into UK VC. And I do think there's a risk there of swamping a market with capital that it's not able to allocate efficiently, and ultimately that's going to depress returns for the entire market. And there will still be a small group of managers, a small group of LPs, hopefully, and a small group of companies that do well even in those challenging times. But it does feel as if that the spread of performance within the industry is probably going to get wider, not narrower, because of these sort of things.
On this podcast, we've had a number of individuals talk about the only pathway now to get returns is through emerging managers and smaller funds. And so it's this old adage of like, David or Goliath, which is the way to returns? And you've been very vocal on like, this is not right. The data does not support this. What does that argument or absolute have wrong from your viewpoint, and how you guys see the opportunity to to invest well in venture managers?
I think they just don't see the returns from the very best funds, from the very best firms, rather, let's call it that, the ones that have been established, the ones that have consistently been able to back those top 1% companies. The performance of those firms isn't generally publicly available. And it's certainly not in a lot of the databases that are out there that contain VC performance numbers. So I think you're just not seeing, what the best managers are able to generate on a returns basis, and how consistent their performance is. Now, if you said, what are the chances of those managers generating a 10x fund? It's going to be relatively low. But the chances of anyone generating a 10x fund are relatively low. I put something out on X recently around what the returns are. How the returns break down for venture based on the PitchBook data, and it's 2% of funds generate 10x plus returns. When we look at the managers, those large managers that we back, across the same vintage spread, which was 2000 to 2019, 5% of their funds generated 10x. So it's not impossible for them to do it. And actually, they do it more frequently than the market generally. So I think you have to really see that sort of data and filter that into your understanding of the VC industry. And what one of the things we have been quite explicit about is publicly sharing that data.
Yeah.
What I don't see from emerging managers and emerging manager LPs is their willingness to share their data in the same way. And I'm, I'd love to be able to see it. If they're not willing to share it publicly, then please share it privately. Because I think one of the things we're always trying to do is to make sure that we're not blindsided. I think the best proxy I've seen for emerging manager data is the Carter returns. And when we compare our performance to the Carter numbers, we're consistently top quartile. And so again, I think a lot of the time it's people not really appreciating how consistently well the best managers are able to perform despite the increase in their fund sizes.
It seems like, and a lot of people have talked about this, the market is really bifurcating, where there's more and more pre-seed, seed, smaller funds, maybe specialized in certain verticals, or the rise of solo GPs, and then firms getting bigger and bigger and bigger and bigger and having multiple strategies. A lot of those firms that have become bigger were kind of like your kind of pure play, standard size and strategy of a venture. Do you think there's a place for this kind of like middle class anymore? Or has this asset class maturated so much, we just have these two different buckets?
I think it's getting harder for that, for those VCs in the middle. Again, there's not absolutes here. There may well be some of those firms that are able to do very well. But I think generally, if you're seeing things, let's look at it from a founder perspective, because ultimately this is, ventures about, can I partner with the best founders? Yeah. And so why would a founder choose to take, firm A's money as opposed to firm B's money? And so I think you have to look at the product that firms are selling founders. And so if you're let's call it a $200 million late seed, early A type firm, and that's it.
Yeah.
It's very difficult for your product to compete with somebody that has, maybe a platform services team where they can help that founder with recruiting, where they can, they've got people on the business development side, so they can help, bring in customers. The advantage that the smaller firms have is that, all of your time is partner time. And, that can be an advantage against some of the bigger firms where, you might be seeing multiple people depending on, ultimately what you want to do. The other part, I think, of the journey is that, if these companies are successful, they're going to need lots of capital and they're going to take time. And there's going to be, multiple additional financing rounds. And I think knowing that you have a partner coming in to lead your Series A, that if things go well, has the capacity, just like Andreessen has done with Databricks, to invest in your B and your C and your D and your E and your F and so on, and support you all the way to IPO and even perhaps beyond. I think that's also a valuable proposition when you're pitching the best founders, because the best founders clearly see themselves on that journey.
I would push back on that, knowing that firms like that are great partners, especially with all of the capital. One side, just quick aside, that also puts them in a position of like, they have to continue investing, or they could it's not a great signal if there's, some flat growth and they're not as involved. So that's one thing. The brand can be given and taken away as well. And so where I'm kind of getting at is like, I think these firms, especially with the power law intensifying, companies staying private longer, they have a place in the market. but are they the best at every stage is my question. And that's why I think that there's probably a place for the exceptions in that kind of middle class, right? Being there, to having more voices that are valuable on your cap table and board.
Yeah, I think, I kind of look at the leading AI companies that have emerged over the last, 2 to 3 years. And then, maybe actually even going a little bit earlier than that as well. What we've seen is that by and large, it's the established names that are the early investors in the vast majority of these. And you might find, the odd emerging manager or the odd firm that's in that kind of middle, that middle ground that does, the odd deal here and there. But I think consistently, if you're looking at the cap table of the leading AI companies over the last few years, it's the established managers that dominate that cap table. And regardless of like how we might want to rationalize, what a founder thinks or what they're looking for, like their behavior is very clear. They want the money from these firms.
Can you, without giving away the names, could you tell me that example, share the example you shared with me about why discounts shouldn't be relevant based on how you're underwriting these assets?
Yeah, so the best secondary we've done in the last 20 years, we bought at a premium and it delivered a 7x multiple. I think it just comes back to why venture is almost a unique asset class. And I think a lot of people that are looking at venture secondaries are doing it from the perspective of private equity secondaries,
Yes.
where you have a more normal distribution of returns in the underlying portfolios, and where you have, really no extreme outliers on either side of the normal distribution curve. In venture, we know that that's very different. And we also know in venture the valuation methodology used is far more of an art than a science. And I think in private, in private equity, it feels there is more quantitative data there to base your valuation decisions on. And so as a result, I think when you're looking at private equity secondaries, most of the value or most of the gain comes from the discount you're able to negotiate rather than necessarily the growth of the portfolio. With venture secondaries, the opposite's the case. The worst thing I think you can do in venture is to buy mediocre portfolios at deep discounts. It looks great for the first couple of years, but long term, that discount just dissipates and you end up, struggling to generate performance. For us, secondaries, it just follows the principle that we apply on the primary side, which is we want to try and maximize our exposure to those top 1% companies and do it in a way that we think is pricing those appropriately given where we think they will ultimately end up. So, the price relative to a bit of an arbitrary NAV that the manager might be reporting, that relationship is far less important to us in venture as we think about it. We probably spend more time thinking about what's the discount relative to the last round value that these companies have raised at? When did that last round happen? If they were raising in the market today, would they be raising at a higher valuation or a lower valuation or the same valuation? And then ultimately we look at, what do we think the terminal outcome of these companies is likely to be and kind of work back from there. It just feels like anchoring around the discount to prevailing NAV is the wrong way to do this.
You hinted at this idea that the difference in return profile of your classic manager fund versus what you're sort of developing on the secondary side is attractive to different types of LPs. And you are an expert at these massive institutions, working with these massive institutions, the sovereign wealth funds, the pension funds. Can you give us any color? A lot of our listeners are so early in their careers in working with LPs on who's buying what now. What categories of some of these institutions are truly looking for the more kind of classic venture alpha versus who's not worth really knocking on the door right now? Like, is Europe closed and Asia is open?
Yeah, I don't think I've got, any sort of real insight there because each, the LPs are not a kind of uniform class. I think each LP is different. And it very much depends on where they are in their kind of journey, within the venture space or within the private equity space. I would say that like just fundraising is hard right now, full stop. And really that's being driven by just the lack of liquidity that's been coming back from private markets generally over the last couple of years. One of the things we do here is that perhaps ventures in a better space from the liquidity side of things than private equity and buyouts.
Yeah.
Because, we have had stuff go public, we have had stuff bought. There was, we've actually had a pretty strong year in terms of distributions back to us. Part of that is funded by the new things that have happened. But part of it is also, there was a chunk of companies that went public in 2021 that our managers were still holding part of their position, and that's being sold down over time. So I think generally, everybody is telling us that outside of a handful of, really high profile brands, like fundraising is a slog. And I think you just have to put the reps in, you just have to do the meetings, you have to have the conversations. There's no kind of shortcut. And I don't get the sense that there's any kind of part of the market that is, particularly active, more so than any others. So I think it's just tough.
David, so since you're, my last question is, so since you established in knowing kind of like these established branded firms and being able to like diligence them really well, something that's kind of a disconnect for me is all I hear as a GP and from other GP friends is like people warning against scope creep. But if we look at the evolution of a lot of these larger firms, one could say they've scope creeped in how they're, what's their structure, what strategies they're applying. Why are they allowed to scope creep? And and are they doing it in a great way? Or like is there a thoughtful way that I'm sure that some firms get big and don't do it in a great way and others do it in a way that there's some congruence? Just kind of work that out for me. I'm going to lay down like it's a therapy session.
Yeah, we talked previously, Ernest, about this kind of purity test that some people have on the bigger managers, and I just don't think it makes sense for me. When I started doing venture in the early 90s, the market was so different from where it is today, and we would be worried if our managers didn't evolve. Because, the opportunity set is evolving, the founders are evolving, they're looking for different things. We want our managers to keep innovating and keep, skating to where the puck is going, not to where the puck has come from. And so I think as long as they're doing that in a way that is sensible, and as long as they're doing it in a way where they've clearly thought out the implications of this, then I think we're supportive of it. It's same for team transition. The worst thing in venture is having the same team for 20 years because, people go stale, they go out of date. You need to continually refresh the partner base at a firm. And I think it's the same with strategy, with focus areas, and with structures as well. But ultimately, with all of that evolution that's happening, it still comes down to the two principles I outlined earlier, which is, are you consistently partnering with the world's best founders? And are you doing that in a way that moves the needle at the fund level? And if the answer to either of those is no, then that's where, we disengage.
Okay. So that's the scope creep. If you can't answer yes on both of those, we're out. I feel like I'm in therapy. Like, your time is up, Ernest. Well, David, thank you so much. As always, I love our conversations, and I love following you on X, and your intention and thoughtfulness is really appreciated in the market, and I hope other people follow.
No, that's been fun, Ernest. Alexa, thanks so much for having me on.
See you later, allocator.
After Portfolio Tile, investing with a smile.